Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. Oh, it's getting exciting at the market, isn't it? Everybody seems so optimistic about the future of this country right now, and rightfully so. On this show, we're going to give you advice on how you can use that optimism and get rich over the long term. Remember, the rules, irrespective of what happens around the country, remain the same. Never invest a lump sum, use an SIP, and invest according to your plan. Don't change your plan for now. Grab a pen and paper, write down my email ID that's at the bottom of your screen. There's also a Twitter handle in which you can get in touch with me and send any question you have about your money. On the show this week, we'll start off by helping a really young man who's going to look after his sister's wedding. We'll help him plan his finances. In our product review, we look at the big Franklin India Blue Chip Fund. We'll find out if you should stay invested. And we'll tell you if you should be buying health covers in India if you're an NRI. Let me bring in Narendra Kumar. Narendra, thank you so much for joining us on the show. Let's get straight to our portfolio segment. Deepak Agarwal has written in, he's 25 years old, Narendra. He takes home a monthly income of 55,000 rupees. Now, this is the thing about Deepak. He's very young, but he's supporting his family. He sent us a list of his investments, and I suspect that these investments have been made based on advice from an older family member. So we are going to treat him like a brand new, fresh investor who's starting off for the first time. This is what he has. 5,000 rupees in his Provident Fund account, which is getting deducted from his salary by his employer. Over and above that, he's invested a lump sum of 40,000 rupees in the Public Provident Fund account, which we keep saying on the show will just duplicate your effort. You don't need to have both. He has 18,000 rupees a year going towards an LIC money back plan, which again we've said on the show is an extremely inefficient way to invest. And he has a few goals. He'd like to buy a flat in Electronic City in Bangalore next year for about 70 lakh rupees. He has 10 lakh rupees already saved for the down payment. He also wants to save for his sister's wedding. This is the thing, Narendra. No insurance, no equity investments, and no loans. Now, let's start off with what he's going to have to undo before he starts actually doing anything. Would you like him to stop that money back policy?
Yes, absolutely. He starts on a very weak wicket, because I would like to give him the approach, why he should be approaching it differently. He needs a large insurance cover, and he should not look at it as an investment. He should look at it as an expense and as, what an insurance is, to get a protection for his family, just in case something happens to him. So, and at this age, he will be entitled to get a very large, cover at a very low premium, given his age. So that should be his topmost priority. He can well discontinue his life insurance policy, the one he has started. He can also, stop putting money in PPF. He should just make that mandatory annual investment which is needed to continue with his PPF account. Beyond that, he may not. There is no commitment. There is no, mandatory requirement to be investing as much as the amount which you have invested last year in PPF. So you just keep it alive. So that your money is intact and the account is live. And beyond that, I think he needs to do very few things. Buy the term cover, get a health insurance for his family, otherwise all his savings plan will be derailed. And invest as much in proven funds, and that too in a balanced fund. Because my sense is that though he's young and he's investing for many years, but some of his goals are not for the very long term. So he needs to approach this very conservatively. And after that, I would also urge him to, consider doing a recurring deposit for the non-negotiable goal, the accumulation for his, sister's wedding, he should just do some estimation of the time frame, 2 years, 2.5 years, plan accordingly so that he has a part of the money which is lying there and it is not dependent on the market.
Well, Narendra, I have two very quick questions for you. He has 10 lakh rupees that he'd like to set aside for that home he wants to buy. Where should he be putting that money for the time being? And secondly, I would like him to start off making even a small little investment into equity right now because it's such a great time. He's only 25 years old. What would you like him to start with? Could you give him the name of a fund that he can use?
He should just methodically put his money in a SIP in a balanced fund. And this 10 lakh rupee which he has to invest should be, he should also work around a time frame. If it is for, 1 year, 2 years, depending on that, he should consider a appropriate a fixed maturity plan or, the appropriate fixed income fund. If he is likely to need this money any time between 1 year to 2 years, then he can well consider a short-term bond fund.
All right, and if you have any more questions, remember you can get back in touch with us. Email ID is at the bottom of your screen. Let's take a few more questions. 43-year-old Avi Mitra has written in. He has savings of 12 lakh rupees right now. He also has 2 young children. He wants to put this money aside in mutual funds, Narendra, with the aim of creating wealth for his own retirement. Now, he tells us he has a moderate risk appetite. So that gives us about 17 years, I think, before his retirement. Where would you like him to put this money? And obviously, not investing it in a lump sum?
Yeah, obviously, not investing in lump sum. And this 12 lakh rupee, if invested in lump sum, even very conservatively, can be very disappointing given the state of market we have suddenly gotten into. So he should, approach this with our growth portfolio or our stable growth portfolio, and spread this money over a long period of time. Given his time frame, he's unlikely to miss this. He's unlikely to miss the bull run, even if he's spreading his money over the next 12 to 18 months. And after that, try and continue this methodical investing, because if this 12 lakh rupee accumulation, if it has happened over a period of time, then maybe your income, which is getting accumulated, can after a period, can well find its way into the same investments.
Let's take another question. Vinay Agarwal has written in. He's been investing in mutual funds since he started watching this show, Narendra. He tells us he's very happy with the returns he's been making. He's invested in the HDFC Top 200 Fund and the DSP BlackRock Top 100 Fund. That investment has been going in as SIPs for the last 3 years. He wants to now start a fresh investment in an equity-linked savings scheme. And he wants to know which fund should he choose, because he not only wants to save tax, but he also wants a fund that will complement the 2 funds he already owns. What would you like him to do?
Yes, these 2 funds, if somebody is investing for 3 years, what has happened in the last 3-4 months can change the complexion or perception. But it's very important to develop a belief in this approach to savings, that you're investing regularly in equity, and over a period of time you never go wrong. A fund to complement this portfolio, I would say, consider quantum tax saving fund or ICICI Prudential Tax Plan.
All right, 2 funds there on your screen right now. Remember, if you have any questions for Narendra Kumar about your investments, feel free to write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Narendra Kumar is with us as well in Delhi. It's time for us to review our fund of the week. And this week, we're looking at a big, massive fund that I know a lot of you are interested in, the Franklin India Blue Chip Fund. Avan is here, and she's going to take us through how the fund has managed to recover over the last couple of months, and then we'll come back and talk about it. Avan.
Thanks, Faye. Well, our fund in focus this week is the Franklin India Blue Chip Fund. In its 21-year history, the fund has enjoyed a consistent run. It is the biggest large-cap fund in the market, with under 5,000 crore rupees as assets under management. The fund has given its investors annual returns of 22.84% every year since its inception. The fund has underperformed the category average only thrice in its 20-year history. It has been in the top quartile consistently from 2008 to 2011. But its rank within the category has slipped sharply from 2012. Specifically, this appears to be a result of an overexposure to telecom stocks and not paying enough attention to FMCG stocks. To sum it up, if you invested 1,000 rupees in this fund when it launched, you would have 28,398 rupees today. But should its long-term track record gain precedence over its recent performance? We find out. With that, it's back to you, Faye.
All right, Avan, thank you so much for that update. Narendra, if we look at the scorecard of this fund, if you take its returns over the last 10 years, it stands number 6 in its category. But if you take its returns over the last 1 year, it stands at 134. Now, when you look at its entire track record of all the years it's been functioning in the country, what's your view of this fund, and how would you rate its recovery over the last 2 months? Has it stayed on top of the market?
No, not at all. If you look at very long-term return, this fund looks outstanding. It's the oldest, well-defined, I would say that it's the oldest stated large-cap fund. It started in 1993 and has been true to its label since 1996. It has remained a large-cap fund. And of late, it has been a fairly conservative and into large-cap, conservatively configured. And it never gets into unknown names. It never tries to be flashy. and it underperforms, and that is what it has done in recent times. It has not gotten into the flashy areas of the large cap universe and has suffered. And it has, often for a prolonged period of time, even in a good market, this fund struggles. And so that is what to expect. But if anybody is investing for 5-7 years, it has never disappointed. So that is still my belief. But going by what we keep telling investors, that be into flexible mandate. And earlier this fund used to have a larger allocation to, of course it was dominantly large cap, but also had meaningful allocation to mid caps as well. No longer. So I would say that it has become a purer large cap, can be disappointing over a prolonged period of time. For 5 years and more, it has always been on top. If we take rolling 5-year performance of this fund, it does well than most others. But I think this fund has not shown any brilliance in terms of being ahead of curve as it used to do 8-10 years back.
But then I want to ask you this right now. There's 4,788 crore rupees invested in this fund, which means those are a lot of investors. What should they do if they're watching right now? What sort of a profile of investor should continue to stay with this fund? And which of us should be looking for better options?
I would say that it is a decent fund. This 4,700 crore is there and built over a period of time entirely because there will be a lot of happy investors and who have accumulated their savings in this fund. This fund never gives a surprise. It doesn't get into it doesn't go into off track. It get derailed with its portfolio. But if you're looking for great performance from a large cap fund on occasion and are willing to withstand, and we are willing to concentrate, that is what we witness in this category. There has been a large number of equity large cap fund which has been launched, and they are very focused. They don't build a very diversified portfolio. They're focused in 20-25 stocks. They bet big. This fund never does that. So if you're looking for a stable large cap fund, this is a good choice. Keep an eye because 3 years when it has been very good time for large cap funds or large cap stocks, or the market was dominated by the performance of the large cap, this fund has not been as impressive.
All right, Narendra, the last time we reviewed this fund on the show, you gave it 5 stars. Where would you place it now? Because
of other options available, I would slot it a notch lower, which is at 4 stars.
All right, 4 stars there for the Franklin India Blue Chip Fund on Investors Guide. Remember, if you have any questions about that review, you can write to us. Email ID is on your screen. Let's move on to our very popular Hold or Sell segment. Well, KP Rajagopal has written in, and he's been investing in this portfolio for the last 18 months. His aim is to create long-term wealth, Narendra. So after 10 years, he wants to gift this amount to his 2 sons. And he wants to know if his portfolio is on track. Right on top, I'm going to take them together. HDFC Equity, DSP BlackRock Equity and L&T Equity. Of the 3 funds, does he have to have all of them? And are they all top-notch?
This is the kind of fund which should be held for, which one should be investing regularly. When I say flexible mandate, a fund which can invest across the market, these are the kind of fund. The disappointing fund of the 3 is DSP BlackRock Equity. Except for that, others are certainly worth continuing.
There's another broad mandate fund that I know you like in his list, and that's the IDFC Premier Equity Plan. For anybody who's watching right now who has a 10, 20, 15-year horizon, is this the fund to go with?
Yes, most certainly. This is a very impressive fund, and it has been a mid and small cap fund based on its portfolio or based on the kind of companies which it owns today or has owned so far. But this is not a mid and small cap fund by design. This fund can be elsewhere or anywhere in the market, and this fund has been an outstanding fund across more than a full market cycle. So this is a must-have so far.
The other fund on his list is very interesting, Narendra. Here's the DSP BlackRock Micro Cap Fund. Now, the DSP BlackRock Fund House in general, all of their equity funds have been suffering over the last year or so. How would you rate this particular fund? And given the rest of the funds in his portfolio, does it make sense to hold on to this one?
Yes, I would not like to club the performance of, or the underperformance or lack of performance of DSP BlackRock Equity Fund with this micro cap, because this is an impressive fund. And this has been an outstanding fund. Any micro cap fund would have suffered, and so has this, or would not have performed and so has this fund. But I think it's the most promising fund among the small and mid-cap category. So if he can withstand the whole, volatility and the declining phase of the market, which he has, I think the coming days are unlikely to be as, you watch your investments go down in value continually. It's unlikely to be that phase of the market. So this, if he can withstand, if he has been able to withstand so far, he must continue on with this fund to generate or to have substantially higher return than most other funds.
I'm going to take the next two funds together, the ICICI Prudential Focus Blue Chip Equity and the Franklin India Blue Chip. We just talked about Franklin India Blue Chip, Narendra. Also for someone with a long-term horizon, focused large cap funds, do they make sense? Would you like him to knock them out of his portfolio?
No, I think he can do without these two funds. They are very impressive large cap fund, but given all that he owns today, and given that he'll be continually investing, he can do without these two funds. And he is adequately diversified. If you look at all the funds that he has, 8 of them, even if we drop 3, it's unlikely to be any compromise on diversification. And so these two funds should not be part of his portfolio.
Last fund on his list, Quantum Long-Term Equity. I know that you're personally quite impressed with this fund. Should he continue investing in it?
Yes, this is again a kind of fund which can invest all over. At the same time, it's a fairly, it's a complementary to what he already has. And everything else, I like this fund simply because if this fund does as, just as well as most other funds, it has a 1.5% or 1.25% cost advantage to all other equity funds. So that is, the performance or the return one may not be certain about that, but one can be very sure of the expenses. And here, this fund always has an advantage of 1.25% annually. That in a long period of time translates into something very substantial.
All right, so there you have it. If you have any questions about what you heard, you can write to us. And of course, if you'd like Narendra to take a look at your entire portfolio, write to us as well. Time for one last question. Rajashri has written in, works in the armed forces. He's been investing in the DSP BlackRock Top 100 and the HDFC Top 200 fund. He also has HDFC Equity, Franklin Templeton Blue Chip, we just talked about it, and the ICICI Prudential Focus Blue Chip Fund. He wants to know if these investments will help him get great returns over the long term. Narendra, quick look at his portfolio. Same advice for him as well. Knock off the Focus Blue Chip funds from your portfolio.
Yes, I would say that in his case, given his time frame and looking at, substantial return from his investment, and more so, of late I have become little positive on the market in terms of, I can say with little more confidence that one is more unlikely to go wrong. So he should replicate our aggressive portfolio if he's willing to assume that risk and in expectation of substantially higher return.
All right, so our aggressive portfolio is on your screen right now. That brings us to the end of this segment. Narendra, thank you so much for joining us on the show.
Thank you.
And answering our questions. We look forward to sitting down with you again next week. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. We've brought in Gajendra Kothari to answer questions on insurance this week. Gajendra, thank you so much for joining us. Our first question comes in from Chintan, who writes in. He's an NRI, but he plans to move back to India soon. He wants to know if he should buy health insurance in India and what is the best option available to him. Gajendra, first of all, does it make sense for him to buy health insurance when he's in India, when he's living overseas? Wouldn't it make more sense for him to wait till he comes back?
Unfortunately, no Indian insurance companies offer health insurance companies for NRIs at this stage. But once you come back to India and settle down, then you have plenty of options available. You can choose from Max Bupa Health Insurance, which is a very renowned player, or also between Apollo Munich Health Insurance. They have certain good plans. So Apollo has a plan called Optima Restore Plan, which can offer you higher sum assured and has no sub limits. And even you can try Max Bupa Gold Plan, Family First Gold Plan, wherein the entire family can be covered, and the sum assured offered is very high there. So you can choose between the two, but you have to wait and you have to come back to India, and only then you can apply for these policies.
Well, Ajish has written in, he invested 30 lakh rupees in the ICICI Life Stage Pension Plan in 2009. He says, over the last few years, the investment has not given him any returns and he blames it on the high charges of that policy. He wants to know if he should remain invested in this policy. Gajendra, unfortunately, for any of our viewers who bought ULIP plans, before the new rules came in, you wound up paying very, very high charges on those plans. Now everybody wants to know what they should be doing with those plans. Gajendra, for someone like him, what's your advice?
In this plan, the policy admin charges is around 2.4% per annum, and also the fund management charges varies from 0.75% to 2.25% per annum. And if you are looking to surrender this policy, then I think you're paying 4% surrender charges. But I think it is better to come out of this policy and else in a low-cost investment product, which can give you superior returns over a period of time.
All right, last question on the show. Gaurav Sharma has written in. He invested in the LIC Jeevan Anand plan. He says this plan gives him a life cover of 5 lakh rupees for 21 years, an annual premium of 24,000 rupees. That sounds like a really expensive plan. He also has a health cover of 1 lakh rupees each for himself and his father. And he wants the cover to be increased for his father. He wants to know how he can do that. I'm going to assume that his father is a senior citizen. Gajendra, 2 questions here. Very expensive policy from LIC. Should he continue it? And how can he ensure a senior citizen?
The plan which you have taken from LIC is a Jeevan Anand plan, which is an endowment plan. In this plan, you're normally not invested adequately, and your insurance is also very inadequate. So what I would recommend you is to go for a term insurance plan. Let's say for your age, you can start with 50 lakh rupees term insurance plan, for which you are only paying around 3,800 rupees. So this is an online term insurance plan I'm talking about, and this will be very cheaper to you, and this provides you with an adequate cover. Now, another thing you talked about is a health insurance plan for yourself and for your father. Even I see here 1 lakh is a too low amount for your requirement, so you should at least upgrade it to a 3 lakh or a 5 lakh cover. And again, you can choose from the options. Various health insurance companies have budget plans as well as premium plans, so you can decide based on the premiums. With regard to your investments, all I can say is that it depends on what goals you have. If you have a shorter term goals, then it doesn't make sense to take a risk. You would be well off by putting your money in fixed deposits or short term bond funds. If your horizon is more than 5 years plus, then only equity funds make sense, because they then has the capacity to deliver inflation beating returns over the longer term.
All right, that's a wrap on Investors Guide this week. Remember, if you have any question at all about your money, you can write to us. We're going to be here week after week, as we have been for the last 5 years, to help you with your money. Email ID is at the bottom of your screen. You can reach me personally on Twitter as well. Send in any feedback you might have about the show. Do you want something changed? It'll be our pleasure to hear from you. Thanks so much for watching.